Hello everyone, and thank you for tuning into OptionGig. In this session, I'm going to cover a topic which is a little of intermediate to advanced level in option trading. And the topic is option trades management. This is one area which separates novice option traders from seasoned option traders. This is one topic which separates profitable option traders from the option traders who lose money. This is the area which separates men from boys in option trading. By option trade management, I mean that you should not just leave the trade when you open the trade, but be ready to actively manage the trade if the market or the stock is not going in the direction you wished it to. Okay. All right. So let's jump right into it. Please pay attention to this one. So if you are doing any other work, just stop doing that for next few minutes and concentrate on this one. I assure you, your option portfolio will thank you for that later on. All right. Let's dive right into it. Before we get into the mechanics of how to manage trades, bigger question is, why should we manage trade? The biggest reason why we should manage trades is by managing the trade actively, we could actually convert a losing trade into winning trade. And I have seen this happening multiple times, wherein a trade was losing money, but I actively managed it and eventually was able to exit the trade at profit. If I had not done anything, I would have lost money in that trade. Second reason is, even if you are not able to convert the losing trade into a profitable trade, you would be able to reduce your eventual loss without increasing risk in the trade. So if you are lucky enough, if you're done management at the right time with the right set of market conditions, you might be able to convert it into a profitable trade. If not profitable trade, you will be able to reduce the eventual loss. Third reason is, if habitually you are actively trying to manage your trades, you stay engaged with your portfolio and with market. You stay engaged, you take action, you do not depend and hope that market and the stock will cooperate. Hope is not a strategy. Engagement is. So these are the top reasons why you should manage your trades actively. Now, there are multiple trade management techniques. In this session, I'm going to cover one of those techniques, and in subsequent sessions on option trade management, I'll cover some of the other techniques. So the techniques that I will cover in this session, technique number one is just give the trade little more time to cooperate. That means if you have put up a trade, and let's take an example that if you have opened a short put trade, means you were bullish on the stock and you opened a short put trade. Stock did not cooperate and it actually went down. Hey, just give yourself more time. Maybe stock will need a little more time to cooperate. Maybe stock will change its direction and come back into the profitable zone. So if you still have your original thesis that you are bullish on stock, then you should just extend the trade to the next expiration cycle. And I'll go through an example of this to make it very clear what do I mean by extending the trade. Okay. Let's dive into an example trade. Let's say your initial trade, when you open the trade, your stock XYZ, that's my favorite stock, XYZ. Your XYZ is trading at $90, and since you are bullish on that stock, you sell a put at $85 strike price and collect a premium of $4. Once again, stock is currently at $90. You are selling a put $5 below the market price. You are selling a put at $85 and you're collecting a premium of $4. What's your thesis? That stock will either stay 90 or go higher and you will be able to retain your premium. Well, like I said, stock may not cooperate immediately, and the scenario is that the stock goes down to 82. Now the put that you sold at a strike price of 85, it is in the money and the trade is going against you. So what do? Apply the technique number 1. That means you should extend the duration of your trade. So your defensive trade in this case is you should roll this trade out to the next expiration cycle. Means if your current trade is for expiring in February, you should close that current trade which is expiring in February and immediately open a March expiration date trade. Same strike price, same number of contract. So you do not take any additional risk in the trade because you are maintaining the same strike, you are maintaining the same contract, but now you have extended the duration of trade. Now the trade instead of expiring in February, it will now expire in March. So you're closing the front month and you're opening the back month trade. Now many broker platforms will allow you to do this in a single order. So you do not have to do this as two separate trades, means closing the front month and then opening the back month trade as two separate trades, but you can do this rolling out in a single trade, and broker platforms allow you to do that. So what happens when you do this? When you roll out your trade from the front month or from the current expiration period to a later dated expiration period, you collect more premium. And because you get more premium, you increase the buffer in your trade. Means you got a little more premium. Initially you got $4 premium. Now if you're moving it to the back month, you might collect additional $2. So now overall you have collected $6 of premium. Means your break-even point is now at, instead of you sold a put at 85, you had collected $4. Now you collected 2 more, so it is $6 premium. Your break-even point has now become $79. So since you collect more premium, it increases the buffer that you have. Secondly, you get more time for stock to come back into profitable zone. Stock was, when you opened the trade, stock was 90, then it fell down to 82. Now you roll it out, you got additional premium, and you have little more time for stock to go back up to 90. So you get more premium, you get more time to be right. And let's say even if the stock doesn't go back all the way up to 90 and stays at 82 or 83, you are still making money in this. Or let's say even if a stock falls down to 78, you lose just $100. So either you you convert your losing trade into profitable trade, or you actually lose less money because you collected a lot more premium by rolling this trade out. So this is a very basic first adjustment technique that you can use to manage your losing trades and convert them into a profitable trade. All this was theory. Now the bigger question is, hey, does it really happen in real life? So let's jump into a real life example. I talked about this in the previous week update on one of the stocks where I have seen exactly the same scenario playing out. So here I'll open my broker platform and let's go through the series of trades that I have done. Alright, so here is a real example of the trade that I was talking about. The ticker symbol is STMP, that means stamps.com. Now I was bullish on stamps.com and I opened a bullish trade at around 22nd of November. That means I opened up a trade when stamp was almost over here, around $90. So, and the trade that I opened was an $85 short put. So gave myself $5 buffer, and then I opened a short put because I was a little bullish on this. But what do we know? Stocks don't cooperate always, what we want them to do. And after I put the trade, the stock just went down. As you can see, I started the trade here, and after that the stock just kept going down. And pretty soon I was losing money on the trade. So what options did I have at that time? I waited and for some time, but then around 9th, means approximately here, I rolled this trade out from January to February month, giving myself a little more time to be correct. And lo and behold, as you can see, the stock actually moved in my direction, and I was able to close this trade profitably just before when it was approximately here. So the trade that could have been a losing trade, I rolled it out, gave myself more time to be correct, and then the trade moved into profitable zone, and I was able to close it at much higher profit than if I had just left the trade as it is. So here let's look at some of the transactions that we had done on this one. So let me go back. So pay attention to these trades. So these are the different trades that happened. The first opening trade was on 22nd. It was a short put at 85. I collected $3.90 as a premium. In the example, that's what I said, approximately $4. Then on 9th of January, we rolled this trade out from January expiration to February expiration, means we closed the January trade and we opened the February expiration trade. Now as you can see, in this case it has been done as a single trade, closing and opening, and by doing this we collected additional $5.25 as a premium. That means the total premium that now I have collected is $5.25 and $3.90. That means approximately $9.15 premium. And then on 17th of January, I closed this trade at $5.88. Means our net profit in this trade, after including the rolls, was, sorry for the bad handwriting, it was $9.15, and you subtract $5.88 from it, approximately $327 as a profit. So this is how we converted a losing trade into a winning trade. I hope this example really helped you to understand how you can use a basic trade management technique of extending the duration to fight back on a trade that is not going in the direction that you want it to, or the trade that is challenging you. In subsequent sessions, we'll cover more adjustment techniques, but that's it for now. Thank you for your time. As always, if you have any questions, please write it to me at optiongig@gmail.com, or if you're watching it on YouTube, you can put your question in the comments. If you are listening it on a podcast, drop me an email. I will also add the link to the YouTube in the podcast show notes, so you can go and watch the video on the YouTube. Thank you very much for your time and happy trading. Bye-bye. Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.